Hi, I'm Carlo Lemmi.
And I'm Robert Chiaretta, and this is International Investor.
Robert, in this episode we are going to discuss the collapse of the public stock markets here in the United States.
Right, Carlo. You know, most people who own stocks, mutual funds, 401k, pension plans, and IRAs don't realize it yet, but they are actually investing in stock markets that are rapidly contracting in size.
But Robert, this is counterintuitive. We all continue to hear how great the stock markets are doing.
Haha. That is because the stock market averages that are often quoted in the media are very narrow in their measure. The Dow Jones Industrial Average Index, for example, only represents the stock market pricing of 30 companies. That's just 30 companies, and only one of which, by the way, has survived since its inception as an index over a century ago. The rest have been replaced as they fell to the wayside.
Robert, you must admit that the stock market averages sure look and feel better now for the average investor.
But it's a false impression, and one that does not really properly diagnose the health and constitution of the capital markets here in our nation. There are several reasons to believe that the U.S. stock markets are weaker and more prone to manipulation today than they were just prior to the financial crisis of 2008. Although the averages are back up to record highs, the markets are actually rapidly shrinking.
This is because a number of factors that we have discovered in our research. For starters, the actual size and breadth of the U.S. stock markets are diminishing.
Correct. But you wouldn't know it to listen to the leadership of the U.S. investment community today.
Well, we caught up with a number of those leaders at a special conference that focused on the stock market and investing in this era of deregulation. The event took place at the Brookings Institute in Washington, D.C., where we first heard from the president of SIFMA, which called itself the voice of the nation's security industry. Let's go there now.
You step back and you look at the U.S. capital market structure, both the equity markets and the fixed income markets, and in the fixed income I would include treasuries, corporates, munis, and even the MBS market. It's pretty impressive. And while we are constantly saying there are changes that need to be made in regulation, create more efficiency, more investor protection, perhaps whatever it may be, nonetheless, it is the envy of the world. And I have the opportunity to travel to Europe, work with my colleagues there, colleagues in Asia, and the Europeans and the Asians look to the U.S. market structure and say that's the market structure we want, because they're a very bank-dependent market structure. In Europe, I think Europe is something like 70-30 bank balance sheet to markets for funding the commercial sector. The U.S. is the opposite of that, which gives us a tremendous amount of leverage and opportunity for capital market growth.
Oh, did you hear that, Carlo? He calls our securities markets the envy of the world.
That is what I call short-term memory, Robert. Wasn't just a few years ago that your financial industry collapsed, creating a global financial crisis?
Yes. I think he has amnesia when it comes to his bravado about our markets. And the very Wall Street investment houses and financial institutions that he represents came crying to our U.S. Treasury Department and Federal Reserve to bail them out. I can tell you, Carlo, that there were not too many small investors nor U.S. taxpayers who would have characterized our markets as the envy of the world back then.
But back to our theme. Are you proposing that we could have another collapse?
Carlo, I am not only proposing it, I maintain that it has already happened, but no one has yet seemed to notice. No matter how you measure it, the publicly traded portion of the stock markets are less than half the size than they were only a decade or more ago. Carlo, let's just take a look at the number of listings, or in other words, the number of companies that are still publicly traded on the New York Stock Exchange and the NASDAQ exchange as well.
Wow! Just look at this graph. The number of companies that are still publicly traded are less than half in number of what they were just 10 years ago. This is quite a downfall.
Carlo, this downward slide has been the result of two important trends. The first is the number of delistings which occur when companies either go out of business or are merged or are privatized or have retired all of their stock.
Robert, why don't you explain what we mean when we say privatize or retired?
Yes. Let's start with the word retiring. By retiring, we mean buying back your own stock from the public so that the only shares that exist are held in private hands, usually management and some key big investors.
Yes, but look at this graph. The number of companies buy back their stock has grown exponentially over the last 20 years. What factors do you think led to that behavior?
Cheap money and an easy fix for a management team that wants to goose their stock when they have run out of better ideas to invest and build their own business.
And by cheap money, you mean the low interest rates that the Federal Reserve and central banks around the world have provided from the last 17 years.
You better believe it, Carlo. Every CEO and CFO out there quickly understood that a great way to bump up your stock price was to borrow from the bank or issue bonds and then use the capital to buy your own stock. That pushes the stock price up and provides a little extra cash in the bank to keep paying your dividends. A short-term way to please your shareholders.
Robert, that sounds like a great way to please your stockholders, but it doesn't really help to invest in and grow the business.
Good point. Nor is it especially healthy for the company's balance sheet. It delivers short-term cash, but it often mortgages the future for the company.
Are these stock buybacks part of the privatization process that you are referring to?
Not entirely. You see, stock buybacks will reduce the number of shares in the public's hands, but they are usually not capable of eliminating all the company's publicly traded common shares held by the public. Rather, most of the privatization now experienced in corporate America is often a result of mergers and acquisitions from either a competing firm or even more likely, the takeover by a private equity firm.
Yes, I was surprised to see how private equity has been growing here in the US and around the world. As you can see in this graph, private equity has been amassing hundreds of billions, even trillions of dollars with which to buy companies. These are industry figures, but I know you suspect that the numbers are even greater than this.
Very true. At International Investor, we have reason to believe that the capital raised by private equity firms now exceeds $7 trillion. And their banking relationships enable them to leverage that several times more.
Well, if this is true, then the private equity investment capital would start to rival the market capital of some of the public markets.
Indeed. That is why in so many cases now, they are able to muscle out ordinary investors and buy the management and their contracts to consummate their takeovers.
But Robert, we found that there is another reason that the publicly traded stock markets are contracting. There are fewer companies being formed and entering the public markets. Look at this graph, which shows the dramatic fall-off in IPOs coming to market. If you look at this chart in isolation, one would conclude that America's days of innovation and new startup companies are coming to an end or over.
And all those forces that are imploding our public markets will make them even more vulnerable to manipulation by the powerful traders on Wall Street.
When we were at the conference, we heard from the head of the Securities and Exchange Commission, who argued for the beneficial effects of good regulation. Let's hear from him now.
Sarbanes-Oxley. Didn't we debate different things about Sarbanes-Oxley? The creation of the Independent Audit Committee with financial sophistication. You know, do you qualify as a financially sophisticated person to serve on this audit committee? And the dialogue between the mandatory dialogue between that audit committee and the auditors is probably one of the greatest enhancements to investor protection that we've had in the last 25 years. And it was actually a fairly low-cost addition. Now, when you get in there and you see the kind of dialogue that audit committees have today with their auditors and, you know, the disclosure that comes out of that versus 20 years ago, you can't help but say this is a huge improvement.
I couldn't agree with him more. Good regulation not only creates a fair playing field for the companies, but gives confidence to small investors who can rely on the numbers that the company professes and the valuations needed to estimate a fair price for their stock. Trust is the essence of our public markets, and it is in danger of being lost.
There are many participants in the stock trading game who will prefer less regulation. Isn't that right, Robert?
Indeed, Carlo. As you can see in these charts, high-frequency traders and short sellers and day traders are just a few of the players who would prefer to have a much freer hand in trading without public or regulatory scrutiny. All of them have distinct and unfair advantages over ordinary investors. They can trade stocks hundreds of times before the public even knows or could possibly react to news signaling investment risks or opportunities.
And the futures and options markets and derivative markets are bigger than ever again. They represent a sophisticated way of trading that ordinary investors have no chance of competing against. I understand the Volcker rule was an attempt to rein in some of this activity, or at least to monitor it.
Correct, Carlo. But remarkably, there are those representing the industry who would prefer even less regulation than currently exists. And in this political climate, with this administration and a Congress beholden to Wall Street's financial contributions, they just might get their wish.
Yes, the president of NASDAQ argues that it's just too costly for Wall Street investment banks to keep track of all the altruistically helpful derivatives they keep creating. Let's go hear his complaint now.
And then as it relates to the regulation changes in the Volcker rule, maybe more specifically, where I sit, and I think the effect of the Volcker rule on our liquidity provision in the U.S. around equity and options markets, and maybe more around the options markets, we saw banks who were really good market makers in the options markets exit. So I think there's constraint on capital for those banks, and I think it's affected the displayed liquidity in the U.S. options markets and the minimum premium offers.
Oh, to hear his lamentations, my heart bleeds. Poor, poor Wall Street. How dare those regulators try to cut some of their obscene profits by forcing them to be more transparent with their derivatives trading. You know, Carlo, it was largely the creation of these derivatives, such as the credit default swaps, the collateralized mortgage obligations, which created the colossal financial crisis of 2008. Now these guys want to recreate these conditions all over again.
Well, they already have. Look at these charts.
Much of this has been designed to create investment vehicles which are extremely difficult for the regulators, let alone Congress and the public, to understand.
Our chairman of SIC argues that there is a good reason for the Volcker rule. Let's listen to him again now.
The policy behind the Volcker rule, that you shouldn't be speculating with depositors' money, right? I think you've heard Secretary Leach on this, you've heard the Fed on this. I don't think anyone says that's bad policy. I mean, I agree. I feel that was good policy. The question is implementation, and we've now implemented it, and something that has that significant an effect, potentially, we should look at whether we've implemented it correctly. I believe that.
I thought he explained quite well how the Volcker rule, for example, will require banks to trade most of their derivatives through a central clearinghouse, which will prevent them, by the way, from commingling their speculative investments with their FDIC-protected funds. You know, that nonsense is exactly what got many of the banks in trouble in the first place and cost U.S. taxpayers many trillions of dollars to bail them out. The average U.S. household is much poorer today as a result of the lack of regulation then, and now some in the financial industry, or I should say most, want us to return to those bad old days again.
But back to our theme of the incredible shrinking stock markets. It is also apparent that more and more stock trades are not done by individuals or even the mutual funds that gather and invest their money for them, but rather other entities.
Right, Carlo. You know, Wall Street's institutions are much more comfortable trading amongst themselves rather than dealing with the retail proletariat. Dark pools and institutional black boxes using mysterious algorithms for trading buy and sell blocks of stock and commodities and futures and options to one another millions of times a day.
Well, let's hear from a former U.S. Treasury official who was involved in the cleaning up of the Wall Street mess of 2008.
I heard him speak at another event in Washington. You know, he spoke about the dangers of shadow banking, hedge funds, and the many new offshore financial entities that are now part of the investment landscape. Let's listen to him now.
Because they do business in 100 countries, so they need a bank that does business in 100 countries. Now think for a second. GM and Ford and Boeing, they manage thousands of parts suppliers all around the world. They seem to figure out how to do that. They can't manage a dozen banking relationships, not according to the big banks. Again, let's test their self-interested arguments that they're making. They really don't stand up. We treat whether it's a bank or a hedge fund or an insurance company, everything, we treat them all the same. Well, the reality is we do have capital standards for banks. And so we felt like it would be too complicated to try to create a capital standard now for a hedge fund, a capital standard for a mutual fund, etc. So we said it would be simpler to just tax the debt of large shadow banks. What we don't want to have happen is all the activity moves from one giant bank to one giant hedge fund, and they debt finance all of that. That's not a reduction in risk. So we only apply the tax to large shadow banks that use debt to fund their activities, and we don't make a distinction between whether it's short-term or long-term debt. I think that's one could look at that as not unreasonable. We just think debt is the source of the instability.
You know, I'm surprised. He is fairly sanguine about the risk posed by this proliferation of financial institutions around the world. We happen to believe that this far greater number of offshore investment players without regulation will end up posing a much greater risk to our own domestic institutions, which will be seduced into playing with them.
Dark pools, black boxes, that sounds like a great way to hide what they are doing.
Keen observation. After all, why reveal to the public your reasons for buying and selling back and forth to a partner when you can drive the stock up or down very easily that way, and no one is to know the wiser when you eventually dump the dog poop on the public. It was hard enough to track when the stock was trading publicly, but in the black boxes and dark pools, all is submerged from prying eyes.
No wonder small investors never seem to do as well as the stock market averages that the media talks about each day. There is evidence to show they never do as well as the big traders.
And that's before they were forced to pay for all the commissions and fees. The 401k plans are nothing more than another dark box by which workers are forced to trap their money into a fee market structure with limited investment prospects. The only reason small investors aren't complaining right now is because their stock and mutual funds are also rising with the asset bubble tide. But in reality, they are only getting the crumbs off the floor of the Wall Street's feast.
And Robert, even after Wall Street milks the 401k cow, it is not enough to satisfy all the greed. We are still seeing as much insider trading today as ever. Even some of the US government institutions have seen their information compromised.
Or hacked.
And finally, we see a lot of this activity moving offshore now.
Actually, we have been reporting on that trend for years. Hedge funds and other offshore partners make it even easier for currency and commodity traders to manipulate the market. And we have seen scandal after scandal unfold over the years with very few convictions and pathetically small fines on the companies involved.
And this is only where they get caught.
Or when there is enough evidence to indict them. But even though the public markets represent but half the number of companies as before, and even though the remaining stocks are owned by privateers and institutional insiders, there is one final part of the remaining public market puzzle that is slowly being taken away from the average American small investor. It's the foreign investors' capture of America's corporate stock.
Wow, you're right. When we started to look at the numbers, I was stunned. Foreigners now own almost 1/4 of all the US corporate stock in the nation.
And with it, Carlo, they are beginning to control the boardrooms, management, and corporate behavior at large.
Well, our chairman of SIC, let's listen to him again now.
Robert Schroeder with International Investor. We've been developing a story about foreign ownership of corporations here in the United States, and we're starting to see a pattern where particularly Chinese cross-holding companies, state-owned enterprises, have been taking significant share positions, not always making it clear that they are developing minority and in some cases majority ownership. We've asked your offices about this, and they really gave us a blank in terms of whether anybody, even in the SEC, is following this.
That's an issue that bothers me. Regardless of the source, because we have what I think is a very good approach to this, which is you don't have to disclose what you're doing. Other people don't get to free ride on your investment thesis until you reach a certain threshold. Mm-hmm. But that applies to everybody working together.
Right.
And so, if this is going on, I welcome your story.
It sounds like he's worried about the foreign ownership of all this public stock and American companies.
He should be, especially Chinese ownership of our corporate world. We did a show devoted to that subject, which is available on our website for those who are interested.
So, Robert, we have proved that the public's access to purchase the stock of America's corporation has dwindled down to a fraction of what it was just a decade ago. What are the implications of smaller and smaller public markets?
There are a multitude of them, and most of them are not good. To start with, Having more and more trading in fewer and fewer hands means, number one, more secretive manipulation is possible behind the scenes and out of the view of regulators. Two, that also allows the fewer large players the ability to sway the markets in one direction or another more easily. Three, this also lends itself to more collusion by those few remaining big players. And four, it gives those players more and more power to buy political influence on Washington, and therefore, five, more eventual control over the regulatory agencies themselves. We are already seeing it in the appointments of secretaries of Treasury, committee members of the SEC, the CFTC, the banking regulators, and soon the Federal Reserve. I have always said that Wall Street loves two things: cheap money and lax regulation. It is getting both right now, and it will continue to party on until the dawn of the disaster.
I actually doubt if most small investors are aware of these trends and their implications.
Absolutely correct, Carlo. We are witnessing the inevitable mutation of greed in its many forms, and these market distortions will continue to grow. Risk is rapidly soaring again, and small investors will, not just by neglect, but by design, be the last ones to know when this balloon is ready to burst.
Now I'm really worried.
That's good, Carlo. That's the first sign of enlightenment. But I'm afraid that's all the time we have for now. I'm Robert Sciaretta.
I'm Carlo Lemmi. Good night and goodbye for international investor.